Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome back Matt Burk. Hey, Matt.
Hey, Mike. Thank you for having me.
Appreciate you having on the podcast. Again, Matt is CEO and founder of Fairway America LLC and Verivest LLC. And appreciate your wisdom coming on the podcast. So let's jump into what's going on out there. The interest rates are high. They're high and too high and too long. And I'll start it this way. I guess I grew up in the former Soviet Union, as you know, when it was still Soviet Union. Complaining about the government action or central bankers is a dangerous trait. Here you can complain all day long. And that's the beauty about the United States. You have a freedom of speech. So we certainly can complain about Jay Powell, Fed chair, going wild, trying to curb the inflation and causing havoc in the industry of commercial real estate. I wish he went a little slower or maybe a lot slower. Things probably would have been just as good. Maybe it would have taken a little longer to get the inflation under control. But that aside, he wouldn't have disturbed the industry to the degree that he has. So we're dealing with this disruption. Love to hear your thoughts on kind of what the whole commercial industry is experiencing, and then where we're going.
Yeah, well, that's a meaty topic. Yeah, I'd say the rapid rise of interest rates over the last, year and a half has caused major pain in the commercial real estate market across the board, as you well know. And if you had anything other than a fixed rate, long-term, debt on a stabilized project, you're feeling the pain. And if you had that and came due anytime soon, you're feeling the pain of the refi, right? So it's been a very, very challenging market. I'd say as challenging, Mike, as any as I've seen in my 30 plus years, 32, 33 years in the finance and real estate space. In terms of where we're going, hard to say, of course. I don't have any better crystal ball than anybody else, but hopefully you're seeing at least rates. I don't see them going back down to, the super low levels that they were. But I don't think they need to in order to see market improvement in the overall, capital markets environment. I mean, this is a very capital markets driven event and downturn, right? And it's lowered the values of commercial real estate. It's put people on the sidelines. It's thrown a giant wrench into the wheels of capital markets to the point where it just has been next to impossible for a lot of people to execute trades and to keep things going. So hopefully 24 starts to get a little bit more, loosens up a little bit. I do think that people are itching to do deals. I mean, there's a lot of money that's built up that wants to do deals. So humans just generally like activity. They like to do things. They like to do deals. So I suspect you see some sense of normalcy, if there is such a thing anymore, returning to the market, then I think you'll start to see some activity, and hopefully you'll at least see some price discovery and some stabilization of values.
Thank you for sharing that. So first question, how much correction do you think has taken place? Of course, it varies city by city, area by area. Obviously, certain areas a lot more volatile. I've seen a lot more. I've seen articles where multifamily in sort of southern regions, maybe Phoenixes of the world, they're down quite a bit. In some other areas, it's a lot less. And it's not just multifamily, other asset classes too. I don't know if you have any general, range, or what do you think correction looks like? And that's the first question. The follow-up question, rescue finance opportunities. I mean, that's the only play today. Rescue finance. What are your thoughts on that front?
Yeah, I think, well, to the first question, I think you're right, Mike. I've always said that real estate, there's not one real estate market. There's many real estate micro markets, and that varies by geographic area, property type. Is it office? Is it retail? Is it multifamily? Is it industrial? What type of industrial? Is it Class A, Class B, Class C? So, there's all kinds of different submarkets that make a broad generalization difficult. But that said, I would say on the stuff that was least affected is anywhere from, 5 to 10%. And on the stuff that's most affected, it could be anywhere up to 40 to 50% or more. In the case of like some certain property types, office in particular, may be, completely obsolete, in which case, the value drops are enormous. But, and, somewhere between 20 and 40%, Mike, I think in a lot of what I'll call, value add projects that weren't at their completion, that had variable rate debt, in them trying to get to stabilization. I think those have gone anywhere down from, low end 10 or 15% to high end as much as 30 and 40.
So with that math in mind, so value on, let's call it value on multifamily. Of course, every market is local. Is there room for rescue capital, or these properties have to go back to the banks and get sold at a, REO like discounts, or
All of the above? I think it depends on the project, depends on the wherewithal of the manager, depends on how close to stabilization, how much more work needs to be done. Are there entitlement issues that need to be dealt with still? What kind of delays do you have from other things that are outside and beyond the manager's control? So there's just so many factors that, again, it's hard to make a broad generalization. But I've seen lots of projects, I mean, as you know, Mike, we have literally dozens, hundreds, even thousands of relationships managers around the country and so forth. And, there's a huge amount of pain, to go around for people that are involved in any sort of value add projects. And so it really just depends on the situation. I do think there is opportunity for rescue capital. If you can, part of the challenge has just been figuring out how to underwrite anything from here on out and forward in terms of what assumptions are you making? What assumptions are you making around interest rates, around caps, around cap rates, around rents, around timing to reach stabilization and lease up rates, right? There's so many different assumptions that you have to make on any given transaction that combine to produce some sort of a targeted or projected outcome. That it's hard, but assuming you can be conservative on a bunch of those assumptions and still see a outcome that makes sense, then yes, I think there's lots of opportunities for rescue capital out in the market today. And if you believe, a more rosy or optimistic scenario, the rates, do start to come down and that capital markets does pick up and people want to put money back in. And you know how it is, Mike. I mean, it's a herd mentality. When times are good, everybody rushes in and pours money into things and it drives asset prices up. And then everybody's, got FOMO. And then they start overpaying for things that they shouldn't overpay for because they're afraid of missing out. And then when the market goes the other way, right, everybody pulls out, tightens up, and nobody's doing anything. And instead of having a moderate, dip, you have a huge dip because there's no liquidity whatsoever anywhere you turn. That's just how people are. It's kind of a herd mentality. So if that starts to go in the other direction, I think you could see a decent move toward more liquidity in the marketplace, and then values stabilize. And then all of a sudden, some of those losses, call them paper losses, that people might have based on today's valuations might not be as bad if they can hang on long enough, right, to get back to a more normal or typical type environment. So, everything is always in flux at some point. It's only if you absolutely have no ability to do something and have to, recognize those losses or gains on a trade that you actually realize them. And until then, everybody's doing the best they can to try to figure out ways to, produce the best outcome they can on the deals that's already in bed with. New managers, new strategies, new funds that are launching. And we see a lot of those, as you know, Mike, in our practice. We do a lot of advisory work for new managers. I'm seeing a lot of people gearing up to try to take advantage of price discovery and trades that just sellers have been hanging on, by their fingernails, right, for the last couple of years, last year and a half. And some of them just aren't going to be able to hang on anymore. And there's a lot of money out there that are trying to take advantage of being able to buy at those types of prices. So if people can get in on a going forward basis on the new, cost basis of the property, then I think there's a lot of opportunity to be had on a going forward basis.
Yeah, I appreciate that great wisdom. The uncertainty and volatility is so high, and lack of predictability makes it difficult. I agree with you 100%. It's just difficult to make any decision. Um, but the fresh money in, let's just call it a rescue capital, and rescue capital could be obviously buying distressed from a bank or from a seller with a bank approval, whatever you want to call a short sale or anything of that nature, or it's just coming in at the existing deal ahead of all existing equity.
Yep.
How do you know when you got a good deal? Because basically, some of these assets are fundamentally strong assets with strong operators, but the challenge is, again, difficult to know what the future holds. And if you can only get to a finish line, so do you underwrite for liquidity to get you through for the next 18 months, 24 months? How long do you think you have to hold down for things get back to, let's just call it stabilization of sort?
Yeah, it's, Mike, it's, as you know, man, you're making a lot of educated guesses that are a combination of, forward looking, thinking around what's going to happen with interest rates, what's going to happen in the economy. It's a presidential election year, a lot of uncertainty around that. You've got war going on and the Middle East and in Ukraine, and it's just a super uncertain environment, generally speaking. So it's very difficult, but I say you end up having to look at it on a combination of project by project information. Like how close to is it at 60% occupancy currently? Is it at 85% occupancy currently? Right. Obviously, depending on which one it is, let's say in a multifamily project, what's your absorption per month? How much rent do you expect to be able to get? Or have rents dropped? If so, by how much? You have to make assumptions. There's a dozen, 2 dozen assumptions on every single deal that you underwrite that you have to put together in some combination. And then you have to have some conviction or belief around how long where rates you think you're going to be, where your exit is you think you're going to be. And if you're not planning to underwrite it to an exit, how long will it cash flow based on the debt that you've got on it? So I just think it's case by case, it's deal by deal, it's location by location until people see a little bit more guidance in the market on where they think things are going from.
Yeah, I appreciate that wisdom. It's hard to see how the cash flow in this environment with these interest rates. That is a mission impossible. It's almost like you just survive to the point where the rates come down, and it's difficult to assume where the rate's going to be. Although we do know the rates are unlikely to keep going up, they appear to have peaked.
They appear to, but then as soon as that happened, right, you saw some numbers that start to give you pauses to see whether or not the Fed really is going to cut rates or not. I mean, it's just nobody really knows for sure. It's just. I'll give you an example of something that a good family office of ours. This isn't even a deal we're involved in. I just know about it because we have a bunch of transactions with this family, and they've got other investments elsewhere, right? But this is a stabilized product, retail, 100% occupied, cash flowing, zero problems on the deal or the transaction. But they had a note come due, right? That was, I don't know exactly what the interest rate was, but let's call it, 4-ish%. And now it comes due, and the best they can do is underwrite that at a 7 or a 7.5 in today's world with a life company or a CMBS deal. And even though it's perfectly stabilized and it's taken 1 penny of money and just trying to refi, it's a $7 million cash in refi, right? So you're having to write a $7 million check just to refinance the deal to meet the debt coverage requirement at today's interest rate. Well, that was an unexpected $7 million of liquidity that, they got to pony up on a deal that otherwise is perfectly good and perfectly stabilized. So, when things like that are happening, right, just think of the ones that aren't stabilized, right, that are in the middle of construction, have some lease up that are going on, that are on a variable rate, and the rate goes from 7.5 or 8 to 11.5 or 12 or 13, it has been a brutal environment for the last, year and a half for a lot of people.
Yeah. So what you just mentioned is, I think the term for it is maturity cliff. That's what they're
Yeah.
talking about. Not only you got the floating rate deal having challenges, but the maturing perfectly good assets that can no longer refi. It's almost like, if you think about this, maturity cliff problem is of such gigantic portions that, if you follow, you could do a great conspiracy theory, right? Jay Powell used to work for Carlyle Group.
Yep.
Large institutional players, they're sitting with massive war chests and they're getting ready to pick up stuff at a massive discount. And these rate hikes is what was forcing that. And all the, let's just call them retail investors, all the mom and pops, all the individual folks are written their checks. It's a scary news to deliver that many of the checks written in the last couple of years are just going to be completely gone. And it's a terrible situation. It's not even clear if there's going to be a solution. The only solution is to somehow the Fed to reverse their stance and realize that destroying a whole sector, probably multiple sectors of the economy, maybe it's a grand conspiracy theory. I don't know. Maybe Jay Powell wants this, so his friends can buy up these assets at a massive discounts. Who knows?
Yeah, well, it's it's not the most far-flung theory in the world. I mean, you like to believe that federal government officials don't have, those kinds of motivations in mind. But you sit there and look at the dynamics in the country today, and the fact of the matter is the big banks and the big shops get bigger and bigger, and the smaller ones don't, right? Because it's just incredibly difficult. I don't know if you've read about this new private funds rule that's coming out, or has been passed, and it goes into effect March of next year, 2025. I mean, we've been doing the homework on all of that, and the reporting requirements for private funds are, I mean, it's just crazy that's going to impose upon private fund managers. And again, all of the burden, the operational burden that's going to be imposed upon people is going to fall disproportionately on the smaller firms that don't have the infrastructure and the sheer size and financial heft and the personnel and the people necessary and the resources necessary to comply with those kinds of laws. So yeah, I mean, it's a huge issue, man. It's in society just generally, the growth of the biggest of the big, just keeps getting bigger, and the disparity between the small and the big gap just keeps widening more and more.
Yeah, I appreciate you sharing that. And I didn't know about the new rules. It's another conversation, not a podcast discussion.
So look it up, man. It's just, yeah. For any fund manager that's out there listening to this right now, look it up. It's the private fund rule, and it's first of all, it's 600 pages long. If you want to read the whole thing,
you need somebody to interpret that.
Yeah. So
more attorneys explaining that.
Yeah, well, then there's, of course, there's summaries of it and so forth. But I mean, it is, yeah. I mean, to your point around conspiracy theories, it's, yeah, I think look at crowdfunding, Mike. I mean, what happened there, right? That the Jobs Act gave rise to that. Crowdfunding came on. It had a huge run for 10 plus years, right? High net worth investors, piled a bunch of money into commercial real estate. And then all of a sudden it falls off of a cliff, right? And causes massive, challenges with lots of deals here the last few years. I mean, I think the next year or two or three is going to be spent, working and minimizing as much damage as possible for those high net worth people, and getting out the other side of it. And then hopefully taking advantage of, the next wave of run up in commercial real estate values. And of course, commercial real estate is highly susceptible to the interest rate, environment. And that's just the way it is, man. It's a capital intensive business. And even if you don't have interest or loans against it, the value of property will fluctuate wildly depending on what's going on with interest rates. If you don't have to sell, that's always better, right? You never want to be in a position where you're forced to have to sell something into an illiquid poor market. But that's hard to not be in that position sometimes if you want to be active in the market when times are good. And people are using debt because leverage, of course, increases your returns if you use it appropriately and the market, it cooperates. But leverage can also eat your lunch if the market goes the other way.
Yeah, true. So what are you doing today? Are you, is Fairway working on the next version of a rescue fund, or is this too early? Is this going to happen?
Yeah,
It's kind of like, well, we're a little early, but at the same time, maybe not. A lot depends on what happens with interest rates and
yeah,
how they
we're
perceive future.
yeah. Fairway's working on a number of new fund initiatives that will be rolling out here fairly quickly. And as much as we're all part of a broker dealer and registered reps and all that, I really can't talk too much about it publicly, but I can say we do have some funds that will be coming down the pike here in the near future. And largely it's around rescue capital strategies, as well as making investments in and with other managers that are doing new vehicles that are taking advantage of various opportunities that are available in today's market. So those will be rolling out here pretty soon. And I do think there's tremendous opportunity. There always is opportunity, right? There's in every downturn or every storm, there's a bright light at the end somewhere. It's, so the challenge in life is, minimizing the damage when you get into the heavy storms, and being in a position to, sail when the sky is blue.
Yeah, I totally hear you. And I'll ask you this question. It's pretty straightforward, but actually came up with discussion with a guest on your podcast, on Very Best podcast, and it was an interesting point mentioned that some fund managers, the new fund managers, are advertising new funds as they have no legacy issues, they're in great shape. Is this, I'm laughing about this because is this better for an investor to look at the new fund manager with a new fund or look at a veteran, even though there's some battle scars, but at least there's expertise, and when they're launching a new fund, it's a new start. Yeah. What do you think?
Well, I would take my chances with people who have been through the trenches, even if they've had, look, it's impossible to go through life without any battle scars whatsoever. And anybody that tells you that they do, I always question how sincere and honest those people are being. But that said, man, I do think there are some really good quality younger managers that are worth investing with, particularly, and a lot of it, as you know, too, Mike, is timing, right? If you invested in 2012, 13, 14, 15, or just about anybody, even if they were poor, you were still going to come out pretty good because the market was working in your favor. But you could invest in the highest quality, most, competent, capable managers and, 21 and 22 and experience some pain because market just moved massively in the opposite direction. That's just the way it is. So I think it's a little close. I'd always bet on the person that has more, battle scars than one that doesn't, like all things being equal. But that said, there's plenty of people on both sides I would invest with and I wouldn't, depending on who they are.
Yeah, I appreciate that. That reminds me kind of the tide that rises all boats. And I vividly remember going, I don't know if you've ever been there, but it's on the East Coast in Nova Scotia, Bay of Fundy. The tides are gigantic. So you see low tides, the boats all the way on the floor, and the high tides, they're all the way up. And that volatility happens every day. There twice a day. It's large. But we're experiencing this here and now, and it's kind of it's very difficult for a lot of people to accept what just happened. And it's even for professionals, for us, difficult to understand. And the most difficult part is, like you said, we don't even know where the market will end up. It might end up to be okay, or it might end up sinking more. It might wind up, who knows, right? It's a difficult. The most difficult part is lack of predictability. A period of time when everything looked just easy to do, and now it's got beyond hard. It's got close to impossible. And yeah, I mean, both you and I have we've got a few battle scars, and we've got some really great successes too. And it's almost this. A lot of investors who have the battle scars will kind of depart the market at the wrong time when they should be coming in, when they should be writing another check. But it's difficult psychologically when you're bleeding.
Yeah, and I'd say anybody that, I mean, that's easy to say. You want to be, I mean, Warren Buffett's famous for that, right? It's like when the tide goes out, who's swimming naked, right? And I think there's a big difference between people who just blatantly, make crazy assumptions for the sake of selling something to an unsuspecting, person because they can. But unfortunately, those people, even in the early innings of a long run, those people can actually end up doing just as well as the person who underwrote it, thoroughly. But I would say that it's really hard, no matter how good you are, to avoid, swimming naked once the tidal wave goes out, right? And the riptide is, under. It's tough, man. But all that said, Mike, I mean, I always feel like I like to deal with people who have, the right mindset, the right approach, who care, who believe in doing the right thing, who are going to be there even when the going gets tough. I'd rather have that than someone who claims they've never made a mistake, because usually they're either lying or they just haven't made the big mistake yet.
Yeah, I agree with you. The true character is revealed through difficulties. That's the bottom line. That's where let's just call them the strong come out, the genuine folks come out, and the success is most of us invest with people. At the end of the day, we want to invest with people who we know, like, and trust, and even during difficult times. So I certainly share their wisdom. Any final thoughts? We are kind of running out of time, but let's just call them, any bright message for the future? Anything positive? Sort of get ready to write fresh checks. I don't know if you can if you beat that drum today, but it feels like we're getting there. We're getting there little by little. Lots of interesting opportunities with the right sponsors, right markets. Could be great. And it's just, it's not invest a convincing message, but more of a, don't hide, don't run away from the battle when now there's opportunity to come in into a really great market. It's almost like Warren Buffett says, be fearful when I was a greedy, and be greedy when I was a fearful. And now it's time to be greedy because others are very fearful. It feels like that. That's what it feels like.
Yeah, I think that's right. I think, cautiously being greedy, and be cautiously greedy, right? And say, don't do anything super stupid. But I do think there are a lot of opportunities that are going to be happening. I've been seeing more and more deals lately that look really good, that are just, hard to imagine how they don't make money. Even if you just have a modicum of a rational market. But it's the wild swings that cause, irrational exuberance or irrational fear, right? That ends up making the markets move so dramatically that I think cause the challenges like in this business. So hopefully we're kind of at the tail end of this last, irrational fear based on, and it's not irrational, I mean, it's reality with the interest rates. But if the Feds hold true to what they say they're going to do, and they at least taper off, and modest decreases, I think you'll start to see people come back in the market, and hopefully we see a much more pleasant, and forward-looking year than we saw in 20.
I appreciate your word of confidence and opportunity. And I'll say this, I guess, it feels like they're going to go slow because they've made it very clear. Fed action is long and variable lags, and they want to see more data, and the data is still not definitive. And they've taken a very harsh stance on inflation. So if anything, they hike very fast, and then they're gonna ease probably slowly. And for some people, it's gonna be too late, while for others, maybe it's enough to help. So let's see.
We'll find out, man. Well, you and me and everybody else will find out as it happens.
Appreciate your wisdom. Thank you for coming on the podcast, and yeah, we'll keep chatting. The journey continues.
Thanks for having me. It's always a pleasure.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.